Your thoughts on not only the milestone we hit this morning, but the fact that we're now taking a breather?
Yeah, it looks that way. We've had a very nice rally over the last year, and most of it's been sponsored by lower interest rates. We haven't seen a big increase in earnings expectations on a forward-looking basis, and that comes amid a global economy that's been very disappointing. Below trend, U.S. growth has been the best, one of the best of the developed markets, but that growth rate's coming down. And we've seen some slippage, again, in today's data in private sector payroll growth, which is now only up 1.5% or so year over year, weakest of the cycle. So in order for this bull case to develop and the market to continue on an upward trajectory, we really need to see an improvement in macro conditions as we head toward mid-year.
David, what do you think of this market right now? I mean, arguably valuations are stretched. Just how important are earnings going to be to a continued upward move?
So I would make a couple of points, Morgan. Yeah, valuations are higher than average, but when macro conditions are favorable, when interest rates are low, when inflation is low, when unemployment is low, that tends to be an environment where valuations are higher than average. So from that perspective, valuations don't look out of whack. The other thing I would say is that valuation is really a very poor timing tool. It has almost no correlation with returns over the next 1 to 2 years. So just looking solely at valuation, I think, is going to be a little bit misleading when we're talking about returns over the next, say, 6 and 12 months. But that being said, so we think valuations are relatively fair. I do think you're going to see an improvement in earnings growth. Last year, earnings in 19 were flattish. This year, as we get a turn in some of the global cyclical areas of the marketplace in terms of earnings, I think you're going to see earnings strength reemerge. We're looking for about 6% earnings growth this year.
Kevin, as much as we talk about how bad Uber's performance has been post-IPO, the stock is up better than 30% since its mid-November low. Some people might be surprised by that. Also, a number of other smaller, kind of mid-cap stocks in tech are doing pretty well. In what a lot of people would imagine to be a stock picker's market in 2020, are those defying that narrative?
No, they're actually. I would look. I'm not speaking about Uber in particular, but a lot of those companies are really more proxies for sentiment at this point. When you look at where the market has come over the last number of months, it's been a huge jump. Many managers looking to square up or beat their benchmarks need to put on risk, and so consequently, those higher beta, smaller cap, more risk-on kind of sectors, those are the places that we'd expect investors to go to first, especially if this improving global growth narrative that we're hoping to see takes hold in the next few years. But to your other guest's point, I think that we're not at that point yet where we're seeing an improvement in growth, but in earnings. But in order to get there, we really need to see a pickup in business spending, which hasn't quite materialized yet. So we're a little more sanguine about our outlook for return to positive earnings growth. So at this point, we're a little bit stretched, and it is going to be a little bit of a stock picker's market so long as we're kind of stuck here with elevated valuations and macro conditions and earnings kind of going sideways.
So, David, based on the analysis you just laid out for this market more broadly, what sectors, what names within it do you think offer the most opportunity?
Right. So we think there is some more upside. In our price target for June of 2020, so about mid-year, is for 3,400 on the S&P, so a little bit more upside from where we are right now. In terms of the sectors that we like most at this point, it's really a focus on the U.S. consumer, which we just saw in the jobs report this morning. Still remains very healthy. Job growth is slowing down a little bit, but still very healthy, and wages are growing if you look at the broader picture. So consumer discretionary, we think, makes a lot of sense. Some of the e-commerce giants are a big part of that sector. We think that still is an area that is ripe for good returns. And the other area that we like is communication services. And that's a sector that has a lot of the internet companies, the media companies. We think internet giants in particular look pretty cheap, still putting up very nice growth rates. And that sector also has the telecom companies, which give you some nice downside protection in case we do see any volatility going forward.